All right, then, thank you for staying with us. Now, global shares dipped on Thursday as investors remain cautious after US President Donald Trump said he had made a deal with Chinese President Xi Jinping, while the dollar rose against the yuan after the Bank of Japan left interest rates unchanged. After a near 2-hour meeting with Xi, Trump said he had agreed to reduce tariffs on imports from China in exchange for Beijing's resuming U.S. soybeans purchases, keeping rare earth exports flowing, and cracking down on illicit trade of fentanyl. Xi urged further cooperation in comments carried by Chinese state media after the meeting. China's Commerce Ministry later said it would pause some countermeasures for a year. Equities market fell on concerns that the truce may prove fleeting. Previous trade negotiations have seen promises started followed by setbacks. Adding to the more downbeat turn in stocks, two of the biggest U.S. tech companies reported earnings that disappointed investors, leaving shares in Microsoft opens new tabs and Meta opens new tabs down 2% and 8%, respectively, in the pre-market. In a heavy day for European earnings, the stock 600 opens new tab, which fell 0.5%. This is a mixed bag indeed. My guest is Mr. Gbenga Ogurinola. He's an investment analyst and a financial advisor. Thank you so much for joining the program. It's been a while, Mr. Ogurinola. Thank you for your time as always.
Thank you, Tolu. It's a pleasure to be here again today.
Yes, I think I would allow you take it up from exactly where I stopped with that introduction. Trump and Xi, they've had that meeting. We've waited so long for this meeting with bated breath. Now they've had this meeting. First, let me ask your reaction to it before you now talk about how it's hitting hard on markets, because we see many markets dipping even after that meeting.
Yeah, so the trade tariff has been a major weapon that President Donald Trump has used against competitors and against other countries since he resumed power. And he has seen that worked in the favor of the U.S. economy. As at the last quarter, it was said that the U.S. economy had raked in about $50 billion as a result of the amendments and negotiations that trailed the trade tariffs. And looking at that, I believe that the president believes that he can still do more and still see how the economy can still rake in more funds through his trade tariffs bargain. And that's what we've seen dominate his financial economy throughout his second term. And I believe that the other countries too are beginning to understand the ropes and know where he is going. So what they try to do is to try to give some grounds in areas where they believe that they can give some grounds, and try to see that it's a winner-take-all thing. So it's not that they are losing much. They are probably losing some grounds, but at the same time, they are still retaining their market share, which is very critical. I think this whole thing is about market share. What is your market share? What percentage of the market do you have? And the two major players, that is China and US, they've been doing a lot of dancing around this time around. But the way it's the market, I believe that for the capital market, going straight to that now, they've been a major beneficiary of these trade tariffs, even though we've had this flip-flop in some cases. But after the storm, you know, you see the prices rally up again, even beyond what they were before the storm. So that's what we've been seeing throughout this year. I mean, after the whole talk of tariffs, negotiations and all that, and counter negotiations, it's always like there's a dip in the market, which we've also seen today. But after those dip, it's like the market bounces back again, and probably even bounces back more than what they were before the dip. And it's been, like I said, year to date, as actually, if you look at the indices, has actually favored a lot of markets. Before now, it used to be just the US markets that probably will have a lot of activities in. But I think with the trade tariffs and people looking inward, they've also been able to activate their own stock markets, where we see other markets too, doing very well considerably this year compared with what used to be the norm.
Interesting stuff, but let take you a bit away and also see what happened in the commodity space with gold in recent times. There's been that large increase, and many would even say it's really a good time to invest in gold. I don't know how that also comes to you, and maybe to react to some other commodities, how they are playing in the market.
Yes, so the commodity markets too have been, they've been very volatile this year. This year we've seen gold reach its peak over $4,200, and we've seen other commodities and digital assets too, also following trail. The U.S.-China tariff war has actually paved way for other commodities, and that's why we see that when there's a trade talk or there is a disagreement where one way or the other, we see the commodity prices either dipping or going up, as the case where, like in the last couple of days, we saw couple of days, not up to about a week or thereabouts, we saw digital assets, crashing, the Bitcoins and other digital assets coming down to as low as, the Bitcoin, it's like $102,000, and we see them going up again, and that was as a result of the trade war debacle between the US and China. So it's also affecting the commodity market. If there's any issue relating to maybe disagreements or issues relating to lack of clarity, the reaction is that the commodity market kind of begins to come down a little, and when there's probably another form of agreement reached, another form of hope reached, then we'll see those things coming up again. So it's been a flip-flop, like you would always say, but generally, I think it's paved way for more attention to those commodities. Now that we see the digital assets markets, we see more of institutional investors coming in now. We are beginning to see more volatility. We are beginning to see more activity in those markets, which predominantly before now had been maybe just retail based, but now that institutional investors are beginning to come in heavily on them, they're becoming more volatile. And so almost every asset class now has a large form of volatility, because it's not just a retailer's market, it's both retailers and institutional investors. And we'll continue to see this in days and weeks to come.
Tech stocks are also doing pretty well, because I know that I've reeled out in the news in recent times for this VDR and all of that are doing pretty well. Where is that putting other segments of the market when you, let's say, we want to rate performance?
Yes, so there's a kind of gray area, or what I would say maybe a caveat, on the tech stocks generally, the Microsofts, the Apples, and the likes. The market in the US generally, there's been this feeling that it's reached a peak and there might be a bubble. But at the same time, there's also this belief that the artificial intelligence introduction and the embracing of artificial intelligence by almost every economy, and the way it's moving so fast could also deepen the tech market and the tech business. And so there's that middle line. Are the prices actually overvalued, or with the AI intro and the belief that there's still going to be more, more innovations and inventions with AI, with the price? Can we actually say that the prices are overvalued? So there's that uncertainty about whether we will say, or that lack of clarity, whether we'll say the market is overvalued as it relates to tech stock or not. But personally, I believe that it's all about demand and supply. As long as we see investors still going for those stocks despite the high prices, then we'll see the prices still going up. It's all an issue of whether there's stability in the economy, where people see that there's stability, where funds still keeps going into that direction of the market, then we would see the prices still going up. Unless there is a major thing that will rock the markets, that's when we can say that probably prices might have a form of correction.
Still getting more interesting. So would you still say it's a good time to invest? You know, I always like you to advise us. Though we're supposed to be paying for this, I know, but let's just take advantage of the fact that you're with us here. Considering this flip-flop, the geopolitical concerns, all of these developments around tariffs and all that, would you still say that the market is interesting to play in at this time, particularly putting your money where your mouth is?
Yes, the market remains a big place where people can make wealth, and it's all about timing, because timing is very critical, you know, as it relates to investments, and also looking at the market returns for individual stocks as it were now. The aspect of a systematic risk is not there, because I mean, the systematic risk affects all the stocks. We're now looking at unsystematic risk, which has to do with individual companies and sectors. We might need to kind of look at the values that those stocks, you know, have in terms of futuristic value. I mean, for companies that still have this futuristic value, I believe that it's a good place to still put money in. What investors might be looking at is look at company stocks that are probably not necessarily major players, but they provide infrastructures, you know, regarding some of these major players, or they provide infrastructures to some of these major players. Now, those stocks, most of the time, are pretty undervalued. And with what is going on in the market, as we begin to see the big stocks, you know, coming to a very high price, people might begin to look at those infrastructural stocks that provides a basis for storage, for electricity, for the major market players. So those are the stocks I believe that investors should begin to look at and see value in those stocks and begin to invest in them. For the major ones, I want to say that some of them are still, in terms of their pricing, in terms of the prospect, some of them are still also good to look into. But if you look at those stocks that provide infrastructures for these major stocks, then they might be the cash cow for investors currently.
Now that we're seeing this truce, you know, reached between Trump and Xi, I'd like to ask generally, in your view, if you think that this would help ease tension across markets and even across trade sectors.
Yes, the tension, like I said, it's something that we've seen play almost all through the year. I mean, we probably have lost count of how many times there have been disagreements and agreements, you know, now. And it's not going to be the last. We're still going to see more of this. What I would just say is that based on the trend that we've seen so far, the market is always resilient to these tensions. And despite the current tensions, I believe that in no time, in the next few weeks, we might even forget that this ever happened again. So that's the way it's been throughout the year, and I think we'll continue to see it this way.
So let's have an outlook now then for the end of the year, for the markets, tradings, and all of that, as we move towards the last few weeks of the year 2025. What are your projections?
Yes, like I said earlier, the market has actually, that the capital market, stock exchanges globally have done very well this year. I mean, we are about the 10th month now, going to just have 2 more months and the year is over. But looking at it generally, the market has done pretty well, and I want to believe that good performance is going to be sustained all through the year. I mean, the Nigerian market has done considerably very well this year. A year-to-date of about 49–50%. I mean, that is really outstanding. I was just taking a look at the cumulative returns for the Nigerian stock market, and in the last 2 years, it's done almost 130%. And I mean, that is really good for the, for investors in the markets. And I believe it's also something that the various regulators should really blow the trumpet about, because I mean, these are things that would make other institutional foreign investors to come into the market and look at what we are doing in the markets. And I believe that this medium is one medium that we can use to actually blow that trumpet. Now, I believe that there's still more to gain in the Nigerian capital market. We are going to see, if we see the market being deepened the more, and there are various options of investments, then we'll see more foreign investments coming into the market. Looking at other markets in the globally too, we've seen some market do very well this year. The DAX, for example, has done about 20.74% year to date. We've seen the Nikkei 225 do about 30.5% year to date, same thing as the Hang Seng. So it's been a good performance generally for most markets this year, and I believe that will be sustained till the end of the year.
Finally, you talked about Nigerian markets, and many journalists like us are worried. We expect some major listings like Dangote refinery and all of that. We're expecting more of this listing. What would you say, or what's your assessment of the performance of the NGX, you know, all of the initiatives?
See what was experienced about 15 years ago in the market, where there was a crash, you know, because the aspect of corporate governance were not fully followed to the latter. So I want to believe that the NGX and other regulators, they are looking at this so that we won't have a bubble again like we had some years back. So those coming into the market should be scrutinized, ensure that everybody plays by the rule, ensure that the reports that are being churned out are actually the real results, and there are sanctions for any manipulation in the markets. I believe that if all these are put in place, we would see our markets compete globally, and there will be more attractions even from foreign investors.
Mr. Gbenga Ogurinola, I must thank you so much for your time on the program. It's been a very interesting session as always. Invest of your day.
Thank you, Tolu. It's always a pleasure.
All right, then now let's review